Imagine this scenario. Your spouse of 42 years passes on, sleep barely comes, food barely matters. The home feels hollow. Every space brings back memories of them. Then, 11 months later, you meet with a tax professional, and they look at you from across the desk and say, "I'm sorry, you missed the deadline. There's nothing we can do now. You had 9 months. The IRS gave you exactly 9 months after your spouse's passing to submit one essential form. And because no one informed you, because you were grieving, because you believed your estate was too modest to worry about, you may have just forfeited a tax protection worth up to $15 million. This is not meant to scare you. This is federal tax law, and today, I'm going to make sure this never happens to you. I'm Faria, and I help retirees and older adults understand the government rules that impact their finances, their benefits, and their loved ones. Today's video could be one of the most important you ever see because I'm going to explain a rule the IRS expects every surviving spouse to know, but almost no one actually does. I'll tell you exactly what the rule is. I'll explain the precise form you must file. I'll cover the deadline, the extension, and even a fallback option if you've already missed it. But I need you to stay with me until the very end, because around the 8-minute mark, I'm going to reveal a hidden second deadline. A completely separate 9-month rule that many estate attorneys don't even bring up in initial consultations. And near the end, I'll share 3 simple steps you can take starting today to protect yourself. So, if you are a surviving spouse or care about someone who could be one someday, please don't click away. This information is too important. Let's start with a story. Robert was 67 years old. He and his wife Linda had been married for 38 years. They lived in the same house they purchased together back in 1992. They had a modest pension, some savings, a life insurance policy, nothing lavish. When Linda passed away in the spring of 2025, Robert was heartbroken. His children helped arrange the funeral. His neighbor brought over meals. His pastor checked on him weekly. But no one, not his children, not his bank, not his insurance agent, told Robert about IRS Form 706. Robert assumed that form was only for wealthy people, millionaires, billionaires, those with yachts and trust funds. His wife's estate was worth about $900,000, well below the federal filing threshold, so he took no action. 14 months passed. Robert's financial advisor invited him in for a routine review. That's when the advisor asked, "Robert, did you file Form 706 to elect portability?" Robert looked confused. He had never heard that term before. Portability, the advisor explained. By filing that one form, Robert could have inherited Linda's unused estate tax exemption, up to $15 million in additional protection. Combined with his own, their family could have shielded as much as $30 million from federal estate tax. "But I'm not wealthy," Robert said. "Why would I need that?" Here's the reason. Robert's home had increased significantly in value. He received life insurance proceeds. He inherited Linda's retirement accounts. And if Robert were to remarry, or if tax laws changed again in the future, that protection could have saved his family hundreds of thousands of dollars. But he missed the 9-month deadline, and the automatic extension window had passed as well. Now let me be clear, Robert's story is fictional, but the rule that affected him is completely real. And situations like this happen to families across the country every single month. So let me explain this rule in simple terms, step by step. Part 1, the portability election. Here's the key rule. When a married individual dies, the IRS allows the surviving spouse to inherit any portion of the deceased spouse's federal estate tax exemption that was not used. The IRS refers to this as the deceased spousal unused exclusion amount. You'll hear professionals call it DSUE. As of 2026, the federal estate tax exemption is $15 million per person. That threshold was established by the One Big Beautiful Bill Act, signed into law on July 4th, 2025. With portability, a married couple can combine both exemptions. That means up to $30 million can be transferred free of federal estate tax. But here's the important part. This does not happen automatically. To claim that unused exemption, someone, usually the executor of the estate, must file IRS Form 706, and it must be filed within 9 months of the date of death, not 9 months from when probate begins, not 9 months from when the will is read, not 9 months from when you feel ready. 9 months from the exact date your spouse passed away. And here's what causes confusion for many families. Even if the estate is small, even if it's worth $100,000, you still need to file Form 706 if you want to secure that portability election. Let me read exactly what the IRS states on their website. An estate tax return must also be filed if the estate elects to transfer any DSUE amount to a surviving spouse, regardless of the size of the gross estate or the amount of adjusted taxable gifts, regardless of the size. The IRS makes that very clear. Part 2, the extension and the safety net. Now, if you're watching this and thinking, I already missed that 9 months, don't panic. There are 2 safety nets. Let me walk you through both. Safety net number 1. If you are still within the original 9-month period, you can file IRS Form 4768. This is a request for an automatic 6-month extension. It extends your deadline to 15 months after the date of death. You must submit Form 4768 before the original 9-month deadline expires. And I want to be clear, this extension gives you extra time to file, but if any estate tax is owed, it must still be paid by the original 9-month deadline. The extension applies to paperwork, not payment. Safety net number 2. If you missed both the 9-month deadline and the 15-month extended deadline, there may still be an option. Under Revenue Procedure 2022-32 from the IRS, estates that were not otherwise required to file, meaning the estate was below the filing threshold, can still elect portability by filing a complete Form 706 on or before the 5th anniversary of the spouse's death. You must include this exact notation at the top of the return, filed pursuant to Revenue Procedure 2022-32 to elect portability under Section 2010 FAC 5A. There is no user fee and no need for a private letter ruling, but this only applies to estates below the filing threshold. If the estate exceeded the threshold and you missed the deadline, you would need to pursue what's known as a Section 9100 relief request. That involves applying for a private letter ruling from the IRS, which can cost thousands of dollars and is not guaranteed to be approved. Part 3, the second 9-month rule no one mentions. Now here is the part I promised you, the hidden second rule. There is a completely separate 9-month deadline under another section of the tax code. It's called a qualified disclaimer under Internal Revenue Code Section 2518. A qualified disclaimer allows a surviving spouse or any beneficiary to legally refuse an inheritance. Why would someone do that? Usually for estate planning reasons. Perhaps the inheritance would push them into a higher tax bracket. Perhaps they want the assets to pass directly to their children or into a trust, but the IRS requires that the disclaimer be made in writing within 9 months of the date of death. And unlike the portability election, this deadline cannot be extended. There is no 5-year backup. There is no simplified option. If you miss it, the opportunity is gone. There is also another condition. You must not have already accepted any benefit from the asset. If you deposited a check, moved into the property, or used the account, the IRS considers that acceptance. Your ability to disclaim disappears. Part 4. The home sale trap. While we're discussing deadlines, let me mention another one that catches surviving spouses off guard. Under IRS Publication 523, a surviving spouse can exclude up to $500,000 in capital gains when selling the family home. That's the same exclusion married couples receive when filing jointly. But you only retain that higher exclusion if you sell the home within 2 years of your spouse's death, and you must not have remarried before the sale. After 2 years, your exclusion drops to $250,000. On a home that has significantly appreciated over decades, the difference between those two amounts could result in tens of thousands of dollars in capital gains tax, or even more when you include the 3.8% net investment income tax and any state taxes. Part 5. Social Security Survivor Benefits. One last point. When a spouse dies, the surviving spouse may qualify for Social Security survivor benefits starting at age 60 or age 50 if you have a qualifying disability. You must have been married for at least 9 months before your spouse's death, and if you remarry before age 60, you generally lose eligibility. There is also a one-time lump sum death benefit of $255. It's a small amount, but it must be claimed within 2 years or it is lost completely. Social Security also limits retroactive payments to 6 months, so if you delay applying for survivor benefits, you could lose months of income you'll never recover. All right, I know that was a lot, so let me simplify everything into 3 steps you can take right now to protect yourself and your family. Step 1, speak with an estate attorney or CPA now before anything happens. Do not wait until a spouse passes away. Meet with a qualified estate attorney or certified public accountant and ask specifically about the portability election, Form 706, and your estate plan. Ask them, if one of us dies, what must be filed within 9 months? Get that answer in writing. Place it in a folder. Tell your children where that folder is. If your spouse has already passed and you are within the 9-month window, contact an estate professional this week. Not this month, this week. Time is the one thing you cannot recover. Step 2, report the death to Social Security immediately and apply for survivor benefits. Call the Social Security Administration at 1-800-772-1213. You cannot apply for survivor benefits online. It must be done by phone or in person at your local Social Security office. Ask about your eligibility for monthly survivor benefits and the $255 lump sum death benefit. Do not delay. Every month you wait could mean benefits you never receive. Step 3, know your deadlines and write them down. Write these on paper and place it somewhere you'll see daily. 9 months after the date of death, file IRS Form 706 for portability and complete any qualified disclaimer if needed. 15 months, the extended deadline if you filed Form 4768 for a 6-month extension. 2 years, sell the family home if you want the $500,000 capital gains exclusion, and also the deadline to claim the $255 Social Security death benefit. 5 years, the final opportunity for a late portability election under Revenue Procedure 2022-32, but only if the estate was below the filing threshold. These are not suggestions. These are strict deadlines set by the IRS and the Social Security Administration. Missing them can cost your family real money, money that could support your care, your grandchildren's education, or your peace of mind in retirement. Before I let you go, I need to say something important. The rules I shared today are current as of 2026, but government policies change, tax thresholds are adjusted, new laws are passed, and the IRS does not send personal reminders when deadlines approach. That means you cannot rely on just this video. You cannot rely on YouTube notifications. You cannot assume someone will remind you. That's why I created something specifically for you. Right now, in the description below this video, there is a link to join the Global Senior Alerts official WhatsApp channel. When you join, you can download a free senior benefits protection guide covering Social Security, pensions, estate tax deadlines, banking rules, insurance policies, and travel regulations for seniors. You'll also receive real-time alerts whenever a rule changes that affects your retirement, your benefits, or your family's financial security. No spam, no sales, just clear, accurate information sent directly to your phone because I believe every senior deserves to understand the rules before those rules are used against them. If this video helped you, please click the like button. That one small action helps this video reach another widow, another widower, another family who may be running out of time without even realizing it. Share this video with your spouse, share it with your children, share it with your neighbor, because the person who needs this information most might not be searching for it. They might be sitting at their kitchen table right now, dealing with grief and assuming everything is fine.